This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
This morning, I get the Wall Street Journal out, and it says, well, we don't care how long this lasts because we're winning. This isn't some damn game.
The House Speaker digging in his heels, the president standing firm, suggesting that a deal is nowhere close to getting done. So why are traders on Wall Street saying, what, me worry?
The hunt for yield. It's what everybody's looking for these days. And one money manager tells us he's found safe ways to get good returns.
And 2 years later, has Apple lost a step since the passing of Steve Jobs, one of tech's greatest visionaries? We have all that and more tonight on Nightly Business Report for Friday, October 4th. Good evening, everyone. I'm Susie Garrett.
And I'm Bill Griffith in for Tyler Matheson. One more night this week. It's day 4 of the government shutdown and work stoppage for 800,000 federal employees. And lawmakers appear no closer tonight to ending the federal budget stalemate, with no negotiations scheduled and the looming threat of a possible U.S. default no less than 2 weeks away now. And that is unless Congress raises the nation's borrowing limit by October 17. John Harwood joins us now from Washington with the latest efforts to reopen the government and the war of words ringing out from the White House to the Capitol and beyond. John, no sign of progress, no?
There's no sign of progress, Bill. At this point, both sides are watching for the reaction of their own members and also those members' constituents back home. You had the president coming out and saying, yes, I will negotiate, but only after the government's reopened and Republicans agreed to join Democrats in raising the debt limit to expand the nation's borrowing authority. Speaker Boehner came out and made the statement that you alluded to, and he's sort of tried to strike both notes about the debt limit, saying, yes, we can't default, but yes, we need concessions on spending and deficit reduction in order to do that. The challenge is the Speaker's been very late to making that demand. Republicans have spent a lot of time on Obamacare demands. Now they're moving to the budget. That's a more promising zone, but it's late in the game.
You know, John, you know Washington inside and out. You know the rhetoric between both sides and both parties. You interviewed President Obama this week. What's your take? What are you sensing about how much longer this is going to go on?
Susie, I think it's going to go all the way up till mid-October. The Treasury says it will be October 17th when we hit the debt limit. I wouldn't expect it to be resolved much more than midnight on the 16th. And, you know, there are various scenarios being discussed. There's no negotiation process, but I talked to a Republican member of Congress yesterday who was speculating that, well, if we just agree on a process of budget negotiations to occur after the debt limit is raised, that might be something that we can consider a victory. And on the debt limit, there's some talk of potentially suspending enforcement of the debt limit rather than raising it. That's what Republicans did earlier this year, and we've been operating on that basis all year.
There was a time when shutting the government down would be unthinkable. Yes, it's happened twice in the last 20 years, but now we're talking very complacently about the fact that the federal government is shut down and could be for another 2 weeks. Does this become the norm in future budget negotiations?
Well, it won't be if President Obama prevails. That's his point. That's what he told me on Wednesday, is the fever that he wants to break in this standoff. He does not want to set any sort of precedent that this becomes routine. And if he can make Republicans break, he'll go a long way toward accomplishing that.
All right, thanks a lot. John Harwood reporting from Washington. Turning now to Wall Street, investors seem to shrug off concerns today about the shutdown and the debt ceiling. Stocks closed modestly higher, but the major averages ended lower for the week. So why the optimism on the Wall Street? Bob Pisani takes a look at how traders see the impact of the shutdown so far as they look ahead to next week in the markets.
Stocks drifted upward today as Wall Street continued to believe that a deal would be struck to get the government back in operation again. Traders continue to express optimism that a shutdown will not be protracted, that it won't go beyond October 17th, and that the debt ceiling will not be breached.
Bottom line, there's no real panic in the equities markets, and that's telling me that the investors realize that although some posturing is going on between both sides will come to an agreement before any major damage is truly done.
Now, one reason for all the optimism is that the tone of the debate has shifted from shutting down Obamacare to just cutting spending. Now, Wall Street believes that both sides can make a deal around that, with the Democrats agreeing on some kind of down payment on entitlement spending and tax reform, and the Republicans agreeing to get the government open again. Stocks traded in a fairly narrow range all week, with the S&P 500 flat for the week. Other major indicators were stable as well. Yields on the 10-year Treasury, for example, have been stable at about 2.6% all week. Now, little wonder that with all this stability, traders have taken to calling this the, what, me worry rally. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And here's a what me worry rally looked like today. The Dow rose 76 points, closing back above the critical 15,000 mark. The Nasdaq was up 33, and the S&P added nearly 12 points. But looking at the last 12 trading days, the Dow and the S&P posted gains for only 3 of them.
And despite the federal budget standoff and the federal work freeze, some encouraging words today about what all this may mean for states and other municipalities. Ratings agency Standard & Poor's said today that a short-term shutdown at the federal level would not have a significant impact on the credit quality of states and local governments, or even for nonprofit healthcare centers and airports and roads and mass transit or public housing.
But the impact of the shutdown is taking a big toll on some private manufacturers. Defense contractor Lockheed Martin announced plans to furlough 3,000 employees starting on Monday, and potentially thousands more in the weeks ahead. And late today, we learned that Computer Sciences is also planning furloughs next week.
Meantime, U.S. Airways is blaming the federal government shutdown for the stranding of one of its jets in France. Listen to this. The carrier ordered a new A330 jet from European aircraft maker Airbus, but because of furloughs in a key FAA office in Oklahoma City, U.S. Airways is unable to fly this new plane into the U.S. And I'm sorry to report that no U.S. Airways passengers have been stranded in France at this time as a result. Susie.
FEMA, the Federal Emergency Management Agency bill, or FEMA, says that as a result of the government shutdown, only 19% of its permanent workforce is available to deal with an emergency. And the announcement comes as Tropical Storm Karen takes aim at the Gulf Coast, which is expected to make landfall on Saturday night. Mandatory evacuation orders have been issued for some areas of Louisiana. Meanwhile, energy output in the Gulf has been cut in half this week as oil and natural gas drillers shut down platforms, evacuating workers ahead of that storm. But some of the biggest energy producers in the Gulf also saw some sizable gains in their stocks today. Look at Marathon Oil, up 2%. ExxonMobil and Anadarko Petroleum both rose 1%. Chevron, however, closed a fraction lower.
It was a great day for new shareholders of Potbelly Corp., with investors gobbling them up on their first day of trading. The Chicago-based sandwich chain had its initial public offering at the Nasdaq today, pricing shares at $14 each, raising better than $105 million. The chain currently has 286 stores nationwide, but CEO Elwyn Lewis says the company is poised for rapid expansion.
We're promising our investors that we're going to grow about 10% units each year. We're a grow to cash type of company. Take that cash, invest it in great new units, get a great return on that investment, and that's the model we're running.
And that's something that investors were able to sink their teeth into today. Look at that. Shares up 120% in their trading debut today.
And Bill, Potbelly is just one of a rash of IPOs this year. Almost 300 equity deals priced over the past 3 months. That's the highest total since 1999 and up 41% compared to last year. This is all according to Deal Logic. The biggest winners, newly public companies in the healthcare sector like Insys, Stemline, and Aratana Therapeutics. Each one has tripled in price. Now, Renaissance Capital says the 2013 class of U.S. IPOs are up 22% this year, easily outperforming the market. But there's one troubling statistic: the number of IPOs with negative returns on day one ticking up to 30%. And Microsoft CEO Steve Ballmer has likely had better days. The software giant's board of directors awarded him a $550,000 bonus for the just completed fiscal year, but that's just 79% of his target bonus figure. The lower amount is because of declining profits from the company's Windows operating system and dismal sales of its Surface tablet computers.
It has now been 2 years since the death of Apple co-founder and CEO Steve Jobs. And at the time, investors were uncertain about the company's leadership, its innovation, and its future. And now, here 2 years later, what's happened since then and where is the company headed? John Ford has our story tonight.
2 years ago, Silicon Valley lost its most famous visionary, Steve Jobs, co-founder and longtime CEO of Apple. He died after a battle with cancer. Since then, the company he built has continued to push ahead as one of the leaders in mobile technology. But has it lost a step? Depends who you ask. In the first year after Jobs' death, the stock rocketed up 85%. Over the next 7 months, it fell all the way back down as investors feared declining margins and the growing popularity of Android devices from Samsung and others. As the stock tumbled, critics focused on Tim Cook, the supply chain guru who succeeded Jobs in the CEO seat. He and the rest of the board initiated dividends and buybacks, engaged with activist investors, and launched efforts like the iPad mini and iPhone 5C that were twists on existing products rather than brand new categories. Is innovation dead at Apple? Complicating matters, rivals like Amazon are ratcheting up the pressure.
We sell these devices at break even. We don't make money when people buy these devices. We want to make money when people use our devices by buying Kindle ebooks, buying movies and TV shows and music and so on.
Makes it hard for companies like Apple that are used to healthy profits. But now sentiment appears to be turning Apple's way again.
We see that Apple is reversing last year's severe downtrend. This tells us that the buyers are taking control from the sellers. This is bullish.
When you swipe into the home screen,
the stock is up more than 20% since June, when the company first showed off its revamped mobile software, iOS 7. And in the past month, users have downloaded iOS 7 more than 200 million times and bought more than 9 million new iPhones the first weekend, both ahead of expectations. And 2 years after its visionary leader passed on, Apple's still a company with something to prove. For Nightly Business Report, I'm John Fort.
And coming up, big investors bought up a big number of houses after the financial crisis, propping up prices. But as home values increase, are they ready to get out? But first, here's a look at how the international markets closed today.
Yes, home prices are dramatically higher from where they were a year ago, up more than 20%. And a lot of those gains came from real estate investors who swooped into distressed markets and bought up thousands of properties. Well, now, as home prices continue to climb, some of those investors are considering pulling out, potentially threatening the price gains that they've helped to create. Diana Olick has our story.
They came, they saw an opportunity, and they bought. Institutional investors lured by big discounts during the foreclosure crisis. They rehabbed the homes to rent, and by buying so many, pushed home prices far higher than expected.
We think that if you get a reasonable cost of capital, both debt and equity, you can actually not only create a very attractive return on a current basis, but in today's market, to your point, the house price appreciation that we think is still in the market is extraordinary.
But those higher prices investors helped create have now caused a pause in home buying, and some investors are looking to get out.
I think the investor market is largely past us. People were buying investment properties 3, 4, 5 years ago. What I hear is that's slowing down now.
Oak Tree Capital and OckZiff, early investors in the trade, are reportedly selling hundreds of homes. But Colony Capital says that's just it. It's not a trade, it's a new asset class. Colony is buying over 1,000 homes a month. American Residential, a single-family REIT, is all in as well.
We're looking at the MLS, multiple list services. We are still looking at REO from the banks, real estate owned product from the banks. We're looking at short sales. We're even buying some traditional houses now where people are just simply putting them on the market.
American Residential has bought 80 portfolios from smaller investors, some of them mom and pop. Foreclosure inventory is down 34% from a year ago, so investors are moving geographically as well. Phoenix, Las Vegas, Southern California, and parts of Florida are already investor heavy. That's why some are now moving into Georgia, the Carolinas, Indianapolis, and Chicago. Blackstone, the largest investor in single-family rentals, says they're not doing any bulk deals and will continue to buy. These investors are modeling after multifamily, and why not? Apartment demand right now is through the roof. For Nightly Business Report, I'm Diana Olick.
Turning now to our market focus segment, a big late day mover is where we begin tonight. Shares of Outer Wall, which operates the Redbox video rental kiosks, surged into the close. Investors snapped up the stock on word that Jana Partners is taking a 13.5% stake in the company. The hedge fund calls shares undervalued and that they represent an attractive investment opportunity. The stock rose 9% to $57 and change. That was in the regular session, and then extended its gains after hours. Shares of medical device maker St. Jude Medical rose today after the FDA signaled it would approve a heart failure detection device. St. Jude is a significant shareholder in the private company CardioMEMS that developed the heart monitoring system. That sent the stock up more than 2.5% to $56.23.
Biogen IDEC is releasing favorable data from an ongoing study of its multiple sclerosis treatment. According to that report, the drug remains effective for patients taking the medicine for at least 4 years with no new safety problems. And that sent the stock higher almost 3% to close at $240.30 per share. And Union Pacific is forecasting third quarter profits coming in below expectations. The railroad operator is blaming the uncertain economy as well as mild weather that hurt the amount of coal that needed to be shipped. That stock fell 1% to $153.90.
Our market monitor guest tonight says the political crisis in Washington is, quote, man-made, and investors should look beyond that and invest for the long term. He's Jack Albin, Chief Investment Officer at BMO Private Bank. Nice to see you again, Jack.
Thank you, Susie.
All right, so what if things get a little dicey on Wall Street and we start seeing some big sell-offs, which we haven't seen so far? Are you still telling investors sit tight?
Yeah, I think for now, and I think, you mentioned it earlier in the broadcast, that it's really sort of a binomial decision. If you believe that the government will ultimately default on its obligations, then you probably don't want to own anything, including risk assets. But on the other hand, if you think they will ultimately kind of work their way through this, and there is somehow light at the end of this tunnel, then probably holding risk assets like equities probably makes sense through here.
Jack, reaching for yield these days has been a dicey prospect because, as we all know, the higher the yield, the greater the risk. And in a low interest rate environment, where do you go these days to find that income?
You're absolutely right, Bill. I mean, with the Fed injecting $85 billion a month into the market, what it's doing is it's keeping interest rates artificially low and kind of trying to push up inflation. And, for those savers are looking for yield in here. And so there are a couple ways we found some yield. One is through bank loans, through an exchange-traded fund with a ticker symbol BKLN. Bank loans are just loans that banks typically make to their customers. But the interesting thing about bank loans is that they're floating rate. They're LIBOR-based, meaning that if interest rates do go up, that the rate that you get on your holding will rise along with it, so that way you won't feel stuck in a rising rate environment holding longer-term fixed-rate obligations.
Now, on that ETF, Jack, that you were just talking about, BKLN, the stock has been pretty much in this $30 range for a while. If someone were to buy that now, what kind of gains can they expect looking ahead?
Again, we're not looking to hit home runs with BKLN. What we're really looking for is just solid, consistent yield. And, at 3 or 4%, it's a pretty good place to be, given that, overnight paper and short-term bonds are virtually zero right now.
But
I actually like the fact that it's not moving around very much.
That one's yielding 4%, as you said. But here's one that's got 6.7% yield, PGX. Tell us about that one.
Sure. PGX is a little riskier, Bill. It is an investment in preferred stock. And interesting thing about preferreds is it is a fixed rate equity that trades like a long-term bond. And so the concern here is if you reach for this 6% yield, you could suffer if interest rates rise. So what I'm recommending is we actually pair that up with with TBF, which is really, I call it an inverse to treasuries, meaning that this is a security that actually rises in value if interest rates go up. So if you believe that preferred stocks will fall as interest rates rise, this thing will pick up the slack and put it both together. You get a nice coupon and some principal stability. So you end up with roughly, I'm going to say, instead of the 6% yield, you end up with around 4% yield, but you have very low interest rate risk.
Okay, real quickly, one other ETF you're recommending, which is a play on Europe, is FEU. This is the Stocks Europe 50 ETF. Tell us quickly in a half a minute why you like it.
Sure. Thanks, Susie. Yeah, so these are the largest, most recognizable names in Europe, like Nestle and other big drug companies and so forth. And really the theme here is we're just trying to play on a recovery that's going on in Europe. We're starting to see a sense that they're breaking away from this long funk. And we're not looking for off to the races here, but we do think there's good value there, and these large companies should benefit.
Okay. All right. Any disclosures to make, Jack?
I own all of it, so and so do our clients.
Okay, fair enough. Thank you so much. Have a great weekend. Jack Ablin, he's Chief Investment Officer at BMO Private Bank.
Still ahead, we may not have gotten a jobs report this morning, but entrepreneurs are still coming up with bright ideas. So tonight we'll introduce you to a woman who turned a simple idea about baby food and turned it into a big business. First, though, how commodities, treasuries, and currencies performed today.
No September jobs report today. That's because the government shut down. But we are still bringing you the latest installment in our Bright Ideas series, as we do every Jobs Friday. Well, until a few years ago, baby food hadn't changed much since the 1930s. That's when it was first sold in jars. Now, organic baby food is almost a $500 million market in the U.S., and those little squeeze pouches that you see in the stores account for about a third of those sales. As Tyler Matheson explains, that means a big appetite for change.
10 years ago, Shazi Visram had a plan. It was long before her husband Joe, their son Zane, or even their dog, that's Willie, were around.
The dream was to change the way children were fed in our country by offering them optimal organic nutrition.
At Columbia University's business school in 2003, this self-described health food nut was inspired by a friend, a mother of twins, who had no time to cook homemade meals.
The market was screaming for something new.
For 2.5 years, starting in her own Brooklyn kitchen, she developed a frozen food moms could prep in a blender. It launched in 5 New York City stores on Mother's Day in 2006.
And probably by June 10th, 2006, I realized that we were not going to make a big splash in the frozen food business.
Happy Baby had to crawl in a different direction, and quickly. They went national in that first year thanks to Whole Foods, but sales of about $116,000 were below projections. The first pivot into cereals called Happy Bellies, then a puff snack.
And it was the first ever organic puff snack for babies.
And then yogurt snacks. Annual sales went to just shy of $7 million, but it was a happy family in name only.
I'm pregnant. I'm trying to take the subway home, and I literally did not have enough credit on one of my credit cards, nor from my debit card, to buy one swipe. I don't know how much lower it gets than that.
Visram says Cliff Schorer, one of her advisors at Columbia, was invaluable, but even he had warned her about the difficulty she'd run into.
And my initial response to that, quite honestly, was, do you have any idea how hard it is to get in the food business?
It all began to change in 2008 when she found applesauce packaged in a pouch.
I remember thinking, that is what we've been looking for all along. That's the alternative to the jar. It's the pouch.
Happy Family introduced Happy Tots in 2009.
Within 2 or 3 weeks, we had 3 items in the top 10 selling items of all the baby foods at Target. And we knew we had something.
Did they ever? 2010 revenues were $13.3 million. In 2012, more than $62 million.
Our business exploded. And it's really a result of this packaging.
That and a little luck. In 2011, American Express featured Visram in a Super Bowl pregame spot.
I was watching the Super Bowl in my den, and Shazi's on television, and I looked at that and I said, that was the wow moment. This is going to be big.
Cliff Schorer couldn't have known how big. This summer, Visram was recognized at the White House.
We celebrate entrepreneurs like Shazi Visram. Shazi is a leader in affordable organic foods for children, which makes Michelle very happy. And they're on track to hit $100 million in revenue this year. So no wonder she's been called a rock star of the new economy.
A rock star indeed. On Mother's Day 2013, the French multinational Groupe Danone in the United States, bought more than 90% of Happy Family.
Their focus is to change the world through nutrition. We set out pretty big, lofty goals, and then they say, okay, how can we help you reach them? I mean, it doesn't get any better than that.
No, it does not. Finally tonight, an unexpected beneficiary of Twitter's initial public offering. Shares of Tweeter, that's a bankrupt electronics retailer, saw shares skyrocket today, its most active day in years. That's because some traders were confused by the ticker symbol TWTRQ for shares of the microblogging website, which haven't even begun trading yet. That will have the symbol TWTR. So they got confused and up the shares went.
Somebody bought 100,000 shares of this consumer electronics company thinking they were getting Twitter.
Oops.
Well, okay. That's Nightly Business Report for tonight. I'm Susie Garrett. Have a great weekend, everyone. And for more on the business stories we covered, go to our website, nbr.com.
I'm Bill Griffith. Tyler's back on Monday. Have a great weekend, everybody.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
I'm Susie Garrett with a Nightly Business Report news brief. On Wall Street today, stocks rose as investors shrugged off concerns about the government shutdown and the looming debt ceiling crisis. The Dow jumped 76 points, closing back above the 15,000 level. The Nasdaq up 33. The S&P added nearly 12 points. Shares of Tweeter, this is a consumer electronics chain, shot up more than 1,500% for a time today after traders confused its ticker symbol with Twitter's. Lockheed Martin is the latest defense contractor with plans to furlough thousands of its employees on Monday. And Microsoft gave CEO Steve Ballmer a lower than expected bonus because of declining profits from its Windows operating system and dismal sales of its Surface tablets. Be sure to tune into Nightly Business Report right here on your public television station.